Gold, silver, oil, also known as commodities. You have probably heard of these already because these are some of the most actively traded assets in the whole world. In this video, I'll explain to you what a commodity is. So what exactly is a commodity? Basically, a commodity is just a raw material or a basic good. Things like gold, oil, silver, natural gas, wheat. These are all commodities. They are not companies and they are not currencies. These are actual physical and tangible things that the world relies on every single day. And that's what makes them so interesting. Because unlike stocks, where you're buying a piece of a company, or Forex, where you're trading one currency for another, with commodities, you're trading something that actually exists, something that's real and physical, something that has direct demand in this world. So let's talk about one of the most popular commodities, oil. Oil is used for transportation, manufacturing, energy, basically everything. So when the global economy is growing, more businesses operating, more traveling, more production, the demand for oil increases. If there's a slowdown in the economy, less travel, less production, then there will be less demand for oil, and the prices tend to fall. Now, commodities such as oil doesn't just change because of the economy. It can also move because of geopolitical tensions. When there's conflict in major oil-producing regions, like what we've seen with the tensions between the United States and Iran, markets don't wait around. They start reacting immediately because traders are usually thinking ahead. If supply gets disrupted, if key shipping routes like the Strait of Hormuz are affected, suddenly there's less oil available to the world. So now you've got multiple forces moving the market at the same time: economic demand, geopolitical risk, and expectations about what could happen next. And this is why oil can move fast. It's not just numbers on a chart, it's the real world being priced in real time. Now, how about gold? Gold behaves very differently from oil. It's not just used for production, it's also seen as a store of value. When people are uncertain about the economy, when there's fear, inflation, instability, money tends to flow into gold. That's why it's often referred to as a hedge against inflation. So when markets are nervous, gold tends to rise. And when everything else feels stable, when people are confident and willing to take more risks, money flows into assets like stocks instead, and gold can slow down and sometimes even drop. Commodities are directly connected to what's happening around the world. Wars, inflation, economic growth, supply shortages, government decisions, all of these things can move commodity prices very quickly. If tensions rise in the Middle East, oil can spike. If supply increases, like a strong harvest season, agriculture commodities can drop. So unlike stocks, where you're focused on a company, commodities force you to think about what's happening on a global level. What most beginners don't realize is commodity prices are not just driven by what is happening right now. They're also driven by what people expect to happen next. If traders believe oil supply is going to tighten in the future, they might start buying before it even happens. If they believe demand is going to drop, they might start selling early. Commodities are heavily influenced by expectations of people. Markets do not move solely based on what's happening. They also move based on what people expect to happen, how confident they are in that expectation, and how quickly that expectation changes. Now layer everything together. You've got real supply and demand, economic growth or slowdown, inflation, interest rates, geopolitical risks, market expectations, and human emotion, all interacting at the same time, all being priced in real time. And this is exactly why commodities can feel fast and very unpredictable, because they are one of the purest markets where real-world events translate directly into price movement. There's no hiding behind long-term narratives. Things move when the world moves. So when you trade commodities, you're not just trading gold or oil. You're trading fear, confidence, scarcity, abundance, stability, uncertainty, and most importantly, which I've been repeating a lot in this channel, expectations and reality. It is a story of how money is reacting to the world around it. Another important thing to take note of is the volatility. Commodities can move fast because when supply or demand shifts suddenly, price reacts immediately. That's why you'll often see sharp spikes in oil or gold. And that's also why risk management becomes even more important when you're trading them. So in conclusion, commodities are real-world assets. and their prices are constantly changing based on supply and demand and global conditions. Understanding that will make things feel more logical. This is where everything starts to connect. Now you've seen stocks, indices, forex, and commodities. Different markets, but all driven by the same core idea. Number 1, expectations. Number 2, demand. And number 3, human behavior. Now you've got a solid understanding of how the markets actually work, from stocks to forex to indices to commodities. But understanding the market is just one part of the process. In the next video, we're gonna take the next step and actually set everything up properly. I'll walk you through how to open a trading account and explain the difference between brokers and exchanges, and what actually matters when choosing where to trade. And choosing where to trade is actually where beginners make costly mistakes. I'll see you in the next one.